valuations are neither high nor low. That's the word coming in from the market mughals who spoke exclusively on ET Now's Voyage panel. Listen in to what the decision makers at Morgan Stanley, JP Morgan and Aditya Birla Sun Life AMC had to say.
The market is trading at 3.2 times book, which is right in the middle of its historical range of 2 to 4. There's nothing in valuations either to celebrate or to be worried about. Okay. Now I know everybody cites the PE ratio and says, oh, the market is trading at 20 times earnings and that's expensive. But remember, earnings are very depressed. We're coming out of an 8-year down cycle in earnings. If you normalize earnings, then the market on a PE multiple is not that rich. So either you normalize earnings and then measure the PE ratio, or default to price to book, which is, which looks through earnings cycles. So I don't think we're dealing with difficult valuations. I think the two big drivers for the market, and I would actually go beyond May 23rd. I think May 23rd will be done and dusted very quickly, and people should not, I don't think they should waste too much time on what's going to happen in the elections, except for an entertainment perspective. I think it's earnings and flows. Yeah. So our view is that earnings are turning. India is coming out of a long drawn down cycle in earnings. And our view is that corporate margins will be entering into a 5-year upcycle. So we're going to get very strong earnings, which will drive this market higher.
If you see the first 9 months of this year, corporate earnings actually grew at about 13%. This after 4 or 5 years when earnings were growing at 6 to 8%. And the fourth quarter should be very good because of a depressed base effect. So I think we're already in a scenario where earnings will grow for fiscal 19 at about 15% plus. And policy by and large is pro-growth. As you mentioned, we've had 2 rate cuts with the potential of 1 more. Fiscal policy is reasonably loose too. So I don't think there's too much to worry on the policy side.
Our market is not exactly very expensive, neither it is cheap. Okay, it's fairly priced. So earnings, market returns will probably track earnings growth in the medium to long term. And that's how I think investors should look at. I think time and again we have seen that 1 year, after a particularly one bad year, normally the next year is always positive. I mean, the probability of that is much higher. That's what we have seen. And last year being a bad year, though Nifty didn't do that bad actually, the broader market was very weak, the mid-cap and small-cap index. I think that should probably come back in this calendar year. And I think long-term returns will again gravitate back to the returns of what the asset class has given in the last 5-10 years, I would say.
India has typically been a very, very capital-starved and a capacity-starved economy. That's typically a case when a country moves from $1,000 to $2,000. It's kind of discovered by many investors, promoters, entrepreneurs, and so on and so forth. For the size of ours, we by now have built a reasonable amount of capital stock ready to be deployed. This, we wouldn't have imagined, so many people coming in from all sorts of places in this country to deploy capital. So, which essentially is about, tells you that it's an evolution in the mindset of an investor that he's ready to kind of deploy risk capital. Which essentially, this also means that your returns would be somewhat depressed because there's a lot more capital today to be deployed, both by promoters and investors.
If you just look at it in the context of emerging markets, investors are running a neutral position on India at this point in time. That's it. I mean, they're not meaningfully overweight, and they're meaningfully overweight on a couple of stocks, which means they're actually underweight the rest of the universe as far as India is concerned. And India has a weight of just about 9% in the EM index. Again, if you look at India in the context of the global index, we have a weight of less than 1%. And this weight is only going to grow by leaps and bounds. And again, investors are barely running a neutral position. And this is a market where perhaps they should be running an overweight position given the growth potential. So I think, in terms of the flows, there'll obviously be, volatility depending on what central banks globally do, and we'll have to live with that volatility. But if you're taking a 3-5 year view, we should feel very optimistic about money coming into the country.
And on that bullish note, it's a wrap on this edition of Market Cafe. Stay tuned, the market is coming up next.